Okay, one thing I want to do in chapter 5 is it's all about financial statement fraud and what are some of the symptoms. And we talk about analytical procedures, but we really don't. Generally, we don't go too into detail with them. But I just want to kind of show you what they're all about. Okay, and we're going to look at fraud. Excuse me, revenue fraud. And what it kind of looks like, how you'd find it in the financial statements. Now, because balance sheets have to balance, you have these all these accounts are kind of linked together. Here's some income statement accounts, and then there are some balance sheet accounts, and they're kind of linked together. For instance, if you make a sale, that sale, if it's on credit, will increase accounts receivable. So you make a sale, have revenue come in, accounts receivable goes up. When you collect that accounts receivable, it turns into cash. When you sell something, your inventory goes down. You sell something that leaves the place and it goes into cost of goods sold, leaves the inventory that's not sold. How do you get inventory? Usually through accounts payable. You buy it on credit. And things like selling expenses usually go hand in hand with revenue. How do you sell more products? Well, you advertise more, or you pay more in commissions, or whatever it is. And so these are kind of the journal entries you normally see for something related to revenues. So making a sale and getting the cost of goods sold. So you sold $1,000. Your sales for $1,000. The stuff that you sold, you paid $600 for. Here's how you collect the accounts receivable. Purchasing inventory, selling expenses. Okay, analytical procedures. Analytical procedures are evaluations you're looking for plausible relationships. And when those plausible relationships aren't there, then you investigate it. Now, it's important to note that analytical procedures of themselves there's one together here. Are usually not proof of fraud. However, they tell you where to look. Now, something like 95% of all fraud is detected through analytical procedures. Because of this, auditors are required to use analytical procedures. It's not optional. You must use analytical procedures, and because they are so effective, is why we do it. They're not effective for proof generally, but they are effective for pointing in the right direction where to look for problems. Okay, so what I want to do is we're going to go through some scenarios. We're going to first start out with financial statements with no fraud. Okay, so this is kind of the income statement here. Oops. So the income statement, we have our sales, our cost of goods sold. And that gives us our gross margin. Take out for the expenses, income tax, and then we have our net income. Well, this is kind of the same financial statement you have seen somewhere else. Anywhere else. Okay, go down to the balance sheet. And on the balance sheet, assets, cash, accounts receivable, inventory, land, building, equipment, buildings, blah, blah, blah. Anything with a value is going to be an asset. So here we have total assets. And we have our liabilities and our equity. Okay, so these have to balance. Now, because these have to balance, it makes for fraud to be a little bit more difficult to do. Okay, and we'll see how that happens later on. Now, as far as the percent changes are concerned, a little bit of a change is not that big of a deal. You know, none of these are too crazy as far as the change is concerned. Yeah, they'll change a little bit. Ratios are the same way. You know, you have these ratios. Gross margin, 40%, 38%. Okay, that's pretty close. 5%, 5.26%. These are all, you know, they will change a little bit, and you expect them to change a little bit. Okay, so these are some common ratios that they would use to look for fraud. And in this case, you'd look at this and go, well, that's, you know, those look about the same as last year and year before and so on and so forth. So, you know, we get probably too excited about any of those. Okay, now there is a relationship between the cost of goods sold and the ending inventory. That is the goods available. So the goods available is the most goods you could possibly sell. So for instance, they had cost of goods sold of 600. They had ending inventory of 200. So the total they could have sold must have been 800, right? If they sold 600, they could have sold another 200 more. And so that's the goods available would be the 200. Now notice, if one of these changes, the other one will change. So if the ending inventory goes up to 300, then this must go down to 500. So this also makes it more tricky for people not to, for someone who wants to create a fraud, because these two are related, and it's very difficult to say you sold something, for instance, and not have it change your inventory. Okay, notice the goods available is not usually shown on the financial statements. Sometimes they are, but for the most part, they aren't. Okay, now ending inventory. There's the amount you have on your books. You know, this is the accounting records, the amount in your inventory, and it should match the physical inventory. So if there's no fraud, it should match or come pretty close. It may be off a little bit, but not much. So the book inventory should match the ending inventory or come pretty close to doing it. Okay, let's start looking at fraud. Okay, let's take the simplest kind of fraud that would probably be easiest to catch. They simply write up their sales by $200 or 200 million, I guess. So notice we went from, oops. You know, maybe they didn't like this well, that's in millions, that'd be like $1 billion. So this would be 1.2 billion. So, you know, 200 million got added on. And notice, you know, going back to this thing, you can't see, when you write up your revenues, you're also got to write up something else. In this case, accounts receivable. Okay, so these are the two accounts that change. Now, you'll notice a few things that are odd. First of all, if you do the percent change by the year, is at 26%, which is massive. All right. You come down here to selling expenses, and you notice they went up a little bit, but not much. You know, this is 8%, almost 9%, and they jumped up by 26%. So, you know, this is odd that you'd have such a small change in the selling expense and an increase in sales. Also, if you had this massive increase in sales, you'd think that there'd be a massive increase in cash coming in, because those increase in sales go into accounts receivable, and those accounts receivable, when they get collected, they turn into cash. Okay, the accounts receivable increase is absolutely bonkers. You know, this thing goes up by 150%. So this is way more than originally is on there. You know, originally we had 150. We just added these fictitious sales, so now it's 350. So these are all things that are going to jump right out at you and say, look, you know, this is a big change. These are big changes. And not only have these big changes, but many of the other accounts don't have those same big changes. Accounts that you would think would. Selling expenses, you know, to have sales jump by 26%, you must have a lot more selling expenses. It's not showing it, and the cash is not. And remember, these are fictitious sales, so they're not going to be collected. They're not going to be collected. So there's not going to be cash coming in. Cash is a big one when it comes to finding fraud, because you can't fool it. Okay. Ratios, the margins are way off. Selling expenses to sales drop considerably. You would think it'd be just the opposite, that it would increase, if anything, to try to get more sales in. But you know, the more advertising dollars, the less they do. But in this case, it went down. Sales to accounts receivable. So this is the accounts receivable turnover. Dropped way down. Why? Because you have all these accounts receivable that are not going to be collected. Cost of goods sold to inventory. We didn't do anything with the inventory, so that one is probably, you know, fine, because actually we didn't change anything in the inventory. And accounts payable to inventory will be fine too. Coming over to the cost of goods sold, and again, because they didn't do anything to the inventory, they'll probably be fine. The ending inventory on the book and the ending inventory, the physical inventory, when you go out and take inventory, are probably going to be fine, because the fraud didn't include anything about cost of goods sold. So these are things, you know, this is the fraud. And the question is, how would you detect it? Well, this is how you would detect it. These ratios are how you would detect it. And you'd start you on looking for how these sales came about. Okay, now frauds come in all different shapes and sizes. So, you know, you don't know really what they did to change the books until you get into it. The second one here is a little bit more sophisticated. They increase the sales by 200, but instead of not including any cost of goods sold, they say, oh no, they increase our cost of goods sold by 120. So you'll notice the change is big, but it's kind of big all the way down here. Selling expense is still really small. This is still a problem. But you'll notice that you don't have these, you know, these numbers are all jumping up together. Coming down here, we have the crazy 150,000. And we have this inventory going way down. Now, this is unusual. I think we talked about this in the Chapter 5 handout. Generally, when your sales go up quite a bit, to feed those sales, to keep those sales going, you order more inventory. So inventory dropping considerably is a problem. You say, well, okay, you got to have stuff on the shelves to keep it going. So if their sales do jump up, you should have an increase in inventory too, usually. Okay, coming over here. Gross margin, about the same. I think it's exactly the same, actually. Selling expenses, still down. Sales to accounts receivable, still wacky. Big changes, big changes, big change in the turnover. Cost of goods sold to inventory. So inventory turned over 5 times. Now it's turning over 15 times. Huge change. 3 times as much almost. Accounts payable to inventory. 137%. So, down here we have these accounts payable to this inventory. These are linked. And we sold out so much of the inventory that we have less inventory than we have for accounts payable. Now, the goods were shipped. They don't say where they were shipped to, but let's assume that they were shipped to some warehouse somewhere or something to make it look like they were sold. This is actually going to look okay because the goods are gone. Where do they go to? Probably some warehouse somewhere, someplace where they were, probably set there to, until the time is right where they really could sell them. Sometimes people try to say, okay, well, we'll get out of it because we'll sell more next year or something. We'll sell it out of this, wherever we ship those to. But anyway, there's still enough there that you would definitely run across this. You could definitely find it. Okay, this one is similar, but the goods are not shipped. So they do the journal entry as if they were shipped, but they don't ship them. They keep them in stock. They might run them in the front door, bring them back in the back door, whatever, or run them out the front in the back, whatever. Okay, so how would this look? Well, it looked very similar. The inventory stuff wouldn't be so whacked out. This doesn't look too bad. This is about the same. Okay. So when it comes to these actual accounts here, because they're actually matching up the sales with the cost of goods sold, it's not too out of whack. But you still have these sales accounts receivable problem. It's going to show you up. Now here's where you're really going to find it, though. Is over here. Because you can't get around that if you sold 720 and there's 800 available, inventory should be on your books at 80. But you ship this stuff back into the place, or not you, but whoever did this. So you take the inventory, you're going to find a whole bunch of extra inventory, which is weird. Inventory is, if it is off, it's almost always, the physical inventory is almost always lower. Why? Because you have things like theft, you have things like breakage. Someone breaks something, they throw it in the garbage. People throw out inventory by accident. There's all kinds of reasons why the physical inventory a lot of times is less than the book. When it's more, that really indicates there's a big problem, because you don't have employees bringing in extra inventory or something like that. So when you have more inventory, physical inventory than is on the books, it indicates there's a big problem. So when you take this inventory, you're going to be shocked because it's not supposed to be like this. Is very unusual to have inventory mismatch that, first of all, is that much, but also that you have more inventory than you have on your books. Doesn't usually work out that way. Okay. This is another type of fraud that happens sometimes. Sales returns. So people return stuff, but the return is not recorded. It is not reduced. Your sales are not reduced. So people returned 130 million of goods here that weren't accounted for. Their sales will be overstated by those returns. So return inventory was added. They kept the inventory that was returned for 80 million. Okay, so you're going to run into some, the percent change here is going to be big. The gross margin is going to be really big. Go to the balance sheet. Notice the inventory really jumps up. And again, that's unusual to have extra inventory. Retained earnings shows quite a bit more just because you have more income. Okay. Gross margin jumps up quite a bit. Gross margins usually don't change by more than a couple percent. So when you see it jump up 8% or whatever, it's a big deal. Selling expenses, again, these are one of the Achilles heels that a lot of times will show that there's fraud, is that the selling expenses don't match the increase in the sales. Okay, sales to accounts receivable jumped up. Cost of goods sold to inventory turnover went way down, and it went down because you have all this extra inventory there. Accounts payable to inventory drops way down because you have all this extra inventory sitting in there that was returned. Okay, so coming over here, again, we run into the same problem we did before. Cost of goods sold was 800. Cost of goods sold, goods available was 800. Cost of goods sold 600. Inventory is 200. So on the books, that'll be 200, but you have this extra 80 in the inventory. So again, this is inventory going up more than the inventory on the books. Very unusual. Possible, but very unusual, and not usually to a large extent. Okay. This is also a very common one. The books are held open at year end. In other words, they're going to include some of the sales from the first week in the next. This should be period. I'll correct that on what I sent out to you guys. Are recorded for 150 and the cost for 90. Okay, so they hold the books open. They say, okay, we'll make a few more sales after the end of the year, but we'll include them in this year's sales. All right, well, the same kind of stuff we've been seeing before is showing up. Ratios, again, wacky. This cost of goods sold inventory one probably isn't too out of control. It's a little bit more, but oops. And accounts payable to inventory, I don't know why I have those marked. Let's take that out. Okay, you come over here though. The physical inventory at year end. So here's the problem. These sales, these happened within, the first week of the next period. So let's say that this is at 1/7/2020. Oops. Now notice that the inventory is a moving target. So at 1/7/2023, the inventory is going to be different than at year end. This inventory would be taken at 12/31/2022. Oops. Let's change it a little bit. Okay. So at year end, the auditors, take the inventory, they come up with this. Because they held the book open, they sold more of that inventory. Now, it may have been replaced in January, but that won't be in the physical inventory at year end if they bought stuff in early January. When they take the physical inventory, it's going to be at 12/31. You're going to have a mismatch. And again, is that terrible mismatch of more inventory, which never happens, than the book. So these are all things, people, when you're auditing a company, when they commit fraud, they don't tell you this. So you have to back out of it. And what you're going to do is, you're going to use these, see what the accounts changed by, use some ratios, and use those to figure out what happened. And again, these are not necessarily just the ratios by themselves. For instance, if you looked at this ratio, it wouldn't necessarily mean there's fraud. If you look at this ratio, you could not look at that and say, oh, there's proof of fraud. That these changed. There might be a logical explanation for it, but it'll tell you to look there. Say, okay, let's look at this. Either the selling expenses are too low or the sales are too high. And if the sales went up by 21%, they're probably too high. If they're generally not evidence though of fraud, you have to get in there and take a look and see where you can find why this is jumped up like that. Okay, so these are kind of analytical procedures, and these are how we find fraud in financial statements. And we're always looking for these plausible relationships. If sales go up, selling expenses go up, by about, somewhere close to the same amount. Things like this down here, that extra inventory is not plausible. You don't have people sneaking inventory into the place and putting it on the shelves. So these are all things that, are ways that you find fraud in financial statements. Okay. Let me save that.